Hello, Assalamu alaikum students. This is your teacher Azka, and today I just come up with one more new video. This is the video for O levels accounting students. This is paper 1 variant 2, as you can see. And this is latest paper 1 multiple choice. We have 35 MCQs to solve. This is May June 2024 variant 2 paper 1. We have 1 hour 15 minutes to solve this whole paper. So now let's start from the last MCQ. Okay. So, question number 35. So, which statement correctly describes the principle of realization? So, basically, what is the principle of realization? Principle of realization means that which states that profit is reorganized when the earning process is complete and the risk and the rewards of ownership have been transferred to the buyer. So, in that condition, we can say that okay, we realize it means that when our profit is earned, whether we receive the income from, whether we receive the money from our customer or not, so till then we cannot realize that sale. So these type of principle called realization. Okay, so now let's see the part A. So profit is earned when a check is received from a customer is payment for goods supplied. So profit is earned when a check is received from a customer in payment for goods supplied. No, it's not like that. Even if you sold something to one of your customer, and even if he didn't pay anything to you, so still you can realize your sale, your profit. So this is not. Profit is earned when a check received from a customer is paid into the business bank account. Profit is earned when the goods are supplied and ownership possess passes to the customer. Yes, once you supplied the good, the customer has accepted your goods. So whether your customer is paying you right now or not, maybe he will be having intention to pay you the money after 1 month or 2 months. But if the ownership passes to the customer, so this is the realization concept. So C is the right option. Okay. So now let's see the question number 34. So Ralph wants to compare the accounting ratios of for his business with the accounting ratios of his brother's business. So what would prevent Ralph from making a meaningful comparison? Okay. So basically, whenever we are trying to compare our accounting ratios with the other businesses, so basically different accounting policies, for example, depreciation methods or inventory valuation methods can significantly impact the financial figures and ratios. And that's why it's making difficult to compare the financial performance of two businesses accurately. So now let's see. So A part is saying the business buy from different suppliers. No, it's not like that. The reason is that because the depreciation method may be changed. Maybe Ralph is using more straight line method or RBM, and his brother is maybe using the reducing balance method or maybe the revaluation method, and maybe the inventory valuation method is not same. So because of that, if they will be comparing their accounting ratio with each other, so it will not you can say that compared accurately. B option is the business have different selling prices. No, it's not like that. Business present their ledger accounts differently. Businesses use different accounting policies. Yes, when the business uses different accounting policies, in that case we cannot compare. So D option is the right option. Okay, so the next question is that Miranda's gross margin fell from 25% in year 1 to 15% in year 2. So what may have caused this? So basically, if there is a reduction in selling price without a corresponding reduction in the cost of goods sold, so would lower the gross margin. So as gross margin is difference between sales and revenue and cost of goods sold, so expressed as a percentage of sales. So now let's read. The first one is that Marinda paid less for purchases in year 2. So if Marinda paid less for purchases in year 2, so it means that her cost of sales are very low. So if the cost of sales are very low, so it means the gross margin would increase. But as you can see that gross margin has decreased in second year. So it's not like that. Marinda purchased fewer goods in year two. Again, it is decreasing your, it is increasing your profit margin, gross profit margin. Marinda reduced her selling prices in year two. Yes, if she decrease his her selling prices, so it is fell from 25% to 15%. Yes, so it can happen because if the sales prices are low, it means that revenue are low. If revenue is low, cost of sales, if the cost of sales is low or high, so whatever the reason is, if this is high or low, but if the revenue is low, so it means that GP margin would also low. That's why it is fell 25% to the 15%. So C option is the right option. Okay, so now let's see question number 32. Abhinav provide the following information. We have the purchases and cost of sales for two different years. We have the inventory of the two 3 dates. What was the rate of inventory or turnover for year ended 31st December 2020? Okay. So first of all, to finding out the inventory turnover, I think I should put this here. So inventory turnover is equal to cost of sales divided by average inventory. So where the cost of sales for the year ended 31st December 2020 is equal to um, 112,500. So now let's calculate the average inventory first. So for average inventory, we have the formula opening inventory plus closing inventory divided by 2. So opening inventory from 31st in the 31st December 2019 is 44,000 and closing inventory is 8,000 divided by 2. So we have $6,000 of average inventory. So now let's find out the average inventory turnover. So 112,500 divided by 6,000 is equal to 18.75, or you can say approximately this is 19 or 20 times. So it means that B option is the right option. Okay. So Mariam does not maintain a full set of accounting records. Only the purchase for the year and the assets and liability valued at the year end are known. So which financial statements can be prepared using this information? Okay. So if we have the purchases, if we have the asset and liability values, so if we have the purchases, so what we can do? Uh, because basically income statement can be prepared using purchases and other information. So as it is focuses on the profit or loss during the period based on revenue and expenses. So however, a statement of affairs typically requires more detailed information on opening balances, so which Mariam does not have. So therefore, only the income statement can be prepared, not the statement of affairs. So that's why uh, the C option is the right option. Okay, so now let's see question number 30. Okay, so question number 30, that Roshan's sales for first year of trading is $55,000 and his gross profit margin is 20%. The closing inventory was 3,200. So what were the purchases for the year? Okay, so now first of all, um, we have the gross profit, so we can easily find out. So GP is equal to sales multiply GP margin is equal to 55,000 was the GP multiplied 20% was the GP margin, and this is equal to 11,000. So it means that we have find it out um, the gross profit. Okay, so now we have to find out the cost of sales. Cost of sales formula is equal to sales minus GP. So sales are 55,000 minus 11,000 is equal to 44,000. Okay. So now we have to find out the um, we have find it out the cost of sales. So by help of this we can find out the purchases. So the formula to of cost of sales are is equal to opening inventory plus purchases minus closing. So because we are not provided with the opening inventory, so we assume that it is $0. So since it's Roshan's first year of a trading, so therefore the formula simplifies to cost of sales is equal to purchases minus closing inventory. So we have the cost of sales, which is 44,000. We have the closing inventory, which is 3,200. And now we are going to rearrange the formula for purchases. So the formula is cost of sales or is equal to opening inventory plus purchases minus closing inventory. Just take out this purchases, make it subject. So purchases is equal to cost of sales plus closing inventory. So 44,000 plus 3,200 is equal to 47,200. So 47,200 are the purchases. So D option is the right option. Okay. So now let's see the next question. That Sam's work in progress was $6,500 at the start of the year and 11,200 at the end of the year. When Sam prepared his manufacturing account, he forgot to make adjustment for work in progress. So how did this omission affect the cost of production and the gross profit? Okay. So basically, work in progress at the start of the year was 6,500 should be added to the cost of production. So while work in progress at the end of the year is 11,200 should be deducted. So since Sam forgot to adjust for work in progress, so cost of production would be overstated. As the higher end of the year work in progress was not deducted. So when the cost of production is overstated, so the gross profit would be understated. So because gross profit is calculated as revenue minus the cost of production, so therefore a higher cost of production leads to a lower gross profit. So it means that it seems that B option is the right option. Okay. So question number 28, manufacturing company provided the following information. We have this information. What was the prime cost for manufacturing? So basically, prime cost in manufacturing includes direct costs such as raw material and direct wages. So it does not include indirect costs like machinery depreciation, supervisor salary, factory rent, or repairs. So given the information, the cost of raw material is 186,000 and the direct wages are 75. So just add these two with each other. 186,000 plus 75,000. So you will be having the 261,000. So this is the prime cost. Okay. Question number 27. So, which statement about the accumulated fund of the society are correct? So, um, so basically, if you see the one, a surplus will increase the accumulated fund and deficit will reduce it. So surplus will increase the accumulated fund and the deficit will reduce it. So this is correct because the accumulated fund represents the net assets of a society. So any surplus or profit increases, so it and any deficit decreases it. And if you see the second one, mm, and the second one is that it includes all monies received and paid during the year. So this is incorrect. The second option is incorrect. First is correct. So why it is this is incorrect? Because the accumulated fund is a balance sheet item representing the net asset. So not a summary of all receipt and payments. So which would be in a cash flow or receipt and payments account. So that's why this is wrong. Now let's see the three. So members cannot make drawings from the accumulated fund. So this is also correct because accumulated fund belongs to the society and it's not available for personal withdrawals by the members. So that's why this is right. And now let's read the four. Four option is saying that accumulated fund is shown as an asset in the statement of financial position. So this is incorrect because accumulated fund is shown as a part of equity or reserves on the liability sides, not as in the assets. So this is also not right. So only one and three is right. So B is the right option. Okay. So after that we have question number 26. So a club received subscription from members totaling 12,600 in the year ended 30 April 2019. So the following information was available. Which amount appeared in the income and expenditure account for a subscription for the year ended 30 April 2019? So we have 12,600. So subscription paid in advance in 2018. So it means that it has been used. It was in advance. So, but now in 2019, it has been used. So that's why we will be adding this 1,300. Okay. So $800 was a year in 2018. So but now that was a year in 2018, but it's being used in 2019, so that's why we have to add this here. And $1,100 is the arrear at the end of the year, so we cannot include this 1,100 in this year's income statement because this is not related to this. So that's why we have to deduct 1,100 from here. So we have the total answer, which is 13,600. Okay. So now let's see the other one. Okay. So question number 25, a company's financial years end on 31st March. On 31st March 2021, trade receivable were 45,000. On 31st March 2022, trade receivable were 41,000. An irrecoverable debt of $1,000 is yet to be written off at 31st March 2022. Provision for doubtful debt is to be maintained at 5%. What is the effect of irrecoverable debt? and the adjustment to the provision for doubtful debts on the profit for the year ended 31st March 2022. So basically, first of all, now let's uh, take step one, write off the irrecoverable debt. So irrecoverable debt reduces the trade receivable directly. So after writing off the $1,000 from debt from the trade receivable at 31st March 2022, so we have the adjusted trade receivables would be 41,000 minus 1,000 is equal to 40,000. And in step two, we are going to calculate the provision for doubtful debts for 31st March 2022. So provision for doubtful debt is 55% of the adjusted trade receivable, and this is a provision for 2022. So 40,000 multiply 5%, and this is giving you $2,000 answer. This is a provision for 2022. And in step three, the provision for doubtful debt for the previous year in 2021 was 5% of $45,000. So for 2021, $45,000 multiply 5%, and this is equal to 2250. So in step four, we will be going to calculate a change in provision. So the provision for doubtful debt decreased from 2250 in 2021 to 2022. So the decrease in provision was 2250 minus 2000 is equal to 250. So now we are going to determine the effect of this thing on profit. So irrecoverable debt of 1,000 reduces the profit, and decrease in the provision for doubtful debt, which is 250, increases the profit because less is set aside. So the net effect on profit would be 1,000 minus 250. So the net effect would decrease by 750. So it means that A is the right option. Okay. So now let's see the question number 24. So which items would appear in the statement of fund changes and equity of X Limited for the year ended 30th June 2020? Okay. So to determine which items would appear in statement of changes in equity for the year ended 30 June 2020, let's analyze each item. So the first thing, which interim dividend paid on 31st March 2020. So this dividend has already been paid during the financial year and would appear as a deduction from the equity in the statement of changes in equity for the year end June 30 June 2020. So it means that this is correct. Now let's see the second one. Second one is the proposed dividend for the year ended 30 June 2020. So proposed dividend are not recorded in the statement of change in equity until they are declared and approved by the board after the financial year end. So hence this will not appear in the statement of changes in equity for the year ended 30 June 2020. Now let's see three. Three is that proposed final dividend for the year ended 30 June 2019 paid on 31st October 2019. So this dividend was postponed in the previous year but paid during the current year, which is October 2019. So it will appear in the statement of changes in equity for the year ended 30 June 2020. So it is also right. And the fourth one is transfer to general reserves on 30th June 2020. So transfer to reserves are recorded in the statement of changes in equity. So this will also appear for the year ended 30th June 2020. So that's why the right answer would be 1, 3, and 4. A option. Okay. So now let's see the question number 23. So T Limited was formed on 1st April 2019. A total of 2,20,000 shares of $2 each were issued, and shareholders were asked to pay 75% of the share value immediately and 25% on 1st April 2020. So by 1st June 2019, holders of 190,000 shares had paid the amount due. So what was the paid up capital on 1st June 2019? Okay. So total issued shares was 220,000, and share value was $2 per share each. Amount required to be paid immediately 75% of the share value, and by 1 June 2019, holders of 190,000 shares had paid the amount due. So first of all, let's calculate immediate payment per share. So shareholders were required to pay 75% of the $2 share value immediately. So it means that how much they have to pay. Give me 1 second. What happening to my pen? Okay. Yeah, so we were talking about the immediate payment per share. So shareholders were required to pay 75% of the $2 share value immediately. So 75% times 2, and this is equal to 1.50 per share. And number of shares for which payments were made by June 2019, which is 190,000 shares, had a 75% of payment completed. And paid up capital on 1st June 2019 multiply the number of shares paid by the amount paid per share. So $190,000 which is paid times 1.50, and this is equal to 285,000. So the paid up capital on June 2019 was $285,000. Okay. So now let's see the question number 22. So where is interest on drawing entered in the accounting records for partnership business? Okay. So let's see. The first thing is that interest on drawings. So interest on drawing is an amount charged to a partner for withdrawing money from the business. So this reduces the partner's share of profit and is treated as a debit to the partner's current account. So it seems to be right. Okay. And is appropriation account is credit because interest on drawing. Yeah. So interest on drawing is treated as an addition to the partnership profits, so which are later distributed among the partners. So, and there is no entry in the partners capital account. There is no entry in the partners capital account because partners capital account, because drawings and related interest typically affect the current uh, account, not the capital. Just give me 1 second. Okay, so basically, interest on drawing is credited to the partner's current account because it represents an amount the partners owes to business, which reduces the balance of the current account. And for the appropriation account is debited um, the because the interest on drawings is considered an addition to the partnership profit, which is a part of profit distribution process. And there is no entry in the partner's capital account as the interest on drawings generally affect the partner's capital account rather than capital account. So the correct answer is indeed B. Yeah, this is the right option. Okay. So The question number 21. The question number 21 is that which item is a current asset. So this is very easy. Current assets will be bank overdraft would be the liability, loan repayable in 12 months. This is the current non-current liability. Prepaid income would be also the current liability. Work in progress would be our asset. This is a type of inventory. Unlimited liability is one of the disadvantages of operating as sole trader. So what is the correct explanation of the unlimited liability? So unlimited liability means that the owner of the business, in this case, the sole trader, is personally responsible for all the debts and liabilities of the business. So if the business cannot meet its obligations, so the sole trader personal assets such as their home or savings, so it can be used to repay the business debts. So this is a key risk of being a sole trader. So as there is no legal distinction between the personal and business finances. So that's why the D option is the right option. Alex purchased goods costing $1,000 and she planned to resell the goods at a markup rate of 25%. These goods were unsold at the year end, were found to be damaged. So Alex estimated that they could be sold for $600. So what value should be shown for these goods in the year and financial statement? Okay. So according to the accounting principle of prudence or convertism, inventory should be valued at the lower of cost or net realizable value. So the cost of goods sold was $1,000, and she has a planned selling price, which is about 25% markup. So it means that $1,000 multiply 1.25, and this is equal to 1250. So net realizable value, the estimated selling price after damage is $600. So since the net realizable value is like 600 is lower than the cost, which is $1,000, so goods should be valued at $600 in the uh, year-end financial statement. Okay. So we have question number 28. So Devendra prepared the following journal entry. We have irrecoverable debt, which is 714, and Tobias, which is 714. So which statement is correct? So basically, journal entry indicates that an amount of 714 has been debited to irrecoverable debt, or it means that bad debts, and credited to the Sobia's account. So debit to irrecoverable debts means that the debt is considered uncollectible, while a credit to Sobia's account means that Sobia's balance is being written off from the accounts receivable. So this indicates that Sobia cannot pay the amount due. So the vendor is writing of the debt as is it is irrecoverable. So that's why the C option is the right option because the Binda, sorry, Sobia cannot pay the amount due to the Devendra. Okay. So now let's see question number 17. So question number 17 is that why is it important to match cost and revenues? Okay. So um, basically the matching principle is accounting requires that cost expenses like me be matched with the revenues and they help generate. So this ensures that income and expenses are recorded in the same accounting period, providing an accurate picture of the profitability for that period. So this is important because it allows for a better comparison of profit from year to year. So as it aligns income with the cost incurred to generate that income. So that's why rather than simply when cash transaction is occur. So that's why C option is the right option so that to enable a better comparison of profit from the year to year. Okay. Okay. So now let's see that trader sold one of his vehicle, which is a general entity to remove the total depreciation on the vehicle sold. So this is very easy. whenever we want to remove the depreciation from the provision for depreciation account. So whenever the provision is increasing, we will be crediting it. But whenever we are selling some vehicle, so we have to debit its provision for depreciation account, and we have to credit the disposal of motor vehicle account. So D option is the right option. Okay. And now let's see the other question. So, Elsevier purchased a motor vehicle costing $8,000 on 1st January 2018. It is depreciated at 40% on the reducing balance basis. So, which journal entry records the depreciation for the year end 31st December 2019? Okay. So, first of all, in 2018, we are going to charge depreciation on this vehicle. So, $8,000 was the cost, and the 40% is the depreciation. So, 8,000 multiply 40 divided by 100. This is 3,200. This is 2018's depreciation, but we have to find out the 2019's depreciation. So what happened in 2019? We have to apply 40%, but on the net book value. So for finding out the net book value, we have to deduct the AD. It means the depreciation from the cost. So 8,000 minus 3,200. This is 4,800. Yeah, and now apply 40% on that. So 4,800 multiply 40 divided by 100. So for this 2019 year, the depreciation is 1920. This is a depreciation for 2019. So whenever we are charging depreciation, so our income statement would be debit, because we suppose, or we considered the depreciation as the expense in income statement. So that's why income statement would be debit, and the provision for depreciation of motor vehicle account would be carried. So A option is the right option. Okay. Okay, so now let's see question number 14. The cost of repairs to machinery was debited to the machinery account. So what was the effect of this error? So basically, a non-current assets, it means that machinery account. The cost of repair should have been recorded as an expense, but it was incorrectly added to the machinery accounts. This causes the machinery account be overstated, as the asset value is artificially inflated by the repair cost. And what about the profit for the year? So since the repair cost was not correctly recorded as an expense, so expenses are understated, leading to an overstatement of the profit. So that's why option A would be the right option. Okay, so now let's see question number 13. Which item would not appear in the purchase ledger control account? Okay, so return inwards refers to goods that customers have returned to the business, so which affect the sales ledger, not the purchase ledger control account. And the purchase ledger control account records the transaction related to supply, such as contra entry, uh, offset between sales and purchase ledger appears, discounts received, reduces the amount owed to the suppliers, and interest charged. Interest on overdue amounts owed to the supplier. So therefore, return inwards would not appear in the purchase ledger control account. So as it relates to sales, not purchases. So D option is the right option. Okay, question number 12. So business keep a complete set of books of accounts, which but is not used as a source of information for making entries in the control accounts. Okay. So sales ledger is a subsidiary ledger that contains individual accounts of customer. It is not source of information for making entries in control accounts. Instead, it is a destination where detailed customer transactions are recorded. So it's not. So entries in control accounts are typically made using information from the cash book, records cash transactions used to making entries, and journal records non-regular transactions like adjustments used for the making entries. And the C is that purchase journal records credit purchases used for making entries. So sale ledger is not used as a source of information for making control accounts entries. So that's why D option is the right option. Okay. We have question number 11. So bank statement of a business showed a credit balance of $280 on 31st December. At that date, there were unpresented check of 312. Standing order is $20 had been incorrectly entered as a 22 on the bank statement. What was the balance in the bank column of the cash book on 31st December? Okay. So given information is that bank statement balance is $280 credit, and unpresented checks were $312, and standing order error, the standing order was recorded as 22, but it should have been $20. So we need to adjust by adding back $2. So first of all, correct the standing order error. So bank statement deducted $22 from standing order, but it should have been $20. So we need to add back $2 into the to the correct this error. So 280 plus 2 is equal to 282. And now we adjust for unpresented checks. So since unpresented checks of 312 have not yet been processed by the bank, so we need to subtract this amount from the bank statement balance, which is 282 minus 312. So we have $30 in minus. So since the result is negative, it means that there is a $30 credit balance in the bank column of the cash book. So that's why option A is the right option. Okay, question number 10. So what would result in the cash book balance being lower than the bank statement balance? Okay. So basically, when a customer makes a payment directly into the bank without it being recorded in the cash book, so bank statement will show a higher balance because the bank has received the money. So however, since this payment is not yet recorded in the cash book, so the cash book balance will be lower than the bank statement balance until the cash book is updated. So let's review. Like the first one is saying that a check received from a customer was not recorded in the bank statement. So this would cause the cash book balance to be higher than the bank statement, as the cash book would record the check, but the bank statement would not. And now let's see the B. So the B is about a customer's check dishonored by the bank appeared only on the bank statement. So this would result in the bank statement being lower than the cash book because the cash book would still show the check as received, but the bank statement would affect the dishonor. And about the D, payment of insurance by standing order was not recorded in the cash book. So this would also result in the cash book balance being higher than the bank statement because the payment has been made by the bank but not yet recorded in the cash book. So C seems to be the correct option. Payment by a customer directly into the bank was not recorded in the cash book because when a customer makes a payment directly to the bank without it being recorded in the cash book, so bank statement will show a higher balance because the bank has received the money. So however, since this payment is not yet recorded in the cash book, so the cash book balance will be lower than the bank statement balance until the cash book is updated. So that's why C option is the right option. Okay. So now let's see the question number 9. Okay. So question number 9 is that a trader took some goods from the business for his own use and he carried the purchases account with the cost price of the goods, which is $200, and carried the sales account with the selling price, which is $300. So which entries did he make to correct the error? So basically, the trader The initial mistake from the trader is that trader credited the purchases account with the cost price of $200, which was incorrect. And the trader also credited the sales account with the selling price of $300, which was not incorrect. So no sale occurred. If we rectify the error, so the first one is that if we credit the drawings, so since the goods were taken for personal use and they should have been recorded as drawings, so we need to debit the drawing uh, by $200 and the cost price of the goods. And if you want to correct the sales account, so the sales account was incorrectly credited with the $300, we need to debit the sales account by $300 to reverse the incorrect entry. So since there was a mismatch between amount, like $300 incorrectly credited to the sales and $200 to the purchases, so a suspense account is used to balance the remaining $100 of difference. So the correct entry to fix this: debit drawings, which is 200, the goods taken for personal use at cost price, debit the suspense, $100 to account for the difference, credit the sales by $300 to reverse the incorrect error to sales. So thus the correct answer is B. Okay. Now let's see the question number 8. Okay, so total of trial balance did not agree and $200 was debited to the suspense account. The bookkeeper then checked the books and found the following two errors. Sale invoice 700 had been recorded in the sales journal as 770 and sales journal had been totaled incorrectly. So what error was made when the sales journal was totaled? So error one, in which a sales invoice for 700 was recorded as 770, meaning the sales journal was overstated by $70. And the total trial balance difference is $200. So difference was debited to the suspense account and an error to the sales journal was totaled incorrectly and we need to determine the amount by which it was incorrect. So error one, the overstatement of $70 from the sales invoice recording contributes to the imbalance. And the remaining difference, the total difference was 200, but $70 of that is already accounted for by the first error. So 200 minus 70 is equal to 130. So this remaining $130 needs to be explained by the incorrect total of the sales journal. So in conclusion, since there is a still $130 discrepancy, so and the sales journal was overcast by this amount, so we can now conclude that the total error in the sales journal would be $200. $70 from the incorrect recording and $130 from the incorrect total. So that's why the correct answer would be B, overcast by $200. Okay. The next question is that a bookkeeper made two errors which cancelled each other out. Which type of errors did this? So this is the compensating error because compensating error occurs when two or more errors are made then that cancel out each other, meaning that despite the mistakes, the trial balance still agrees. And the B is complete reversal. This happens when the correct amounts are entered, but the debits and credits are reversed. So this is not. And the original entry means this occurs when an incorrect figure is used from the start, affecting both debit and credit sides. And the error principle is this error occurs when an entry is made in the wrong type of account, for example, recording a revenue item as a capital item. So that's why A option is the correct answer as it refers to errors that cancel out each other. So this is the right option. Question number 6. So what is the double entry for recording a check payment to a credit supplier? Okay. So C option seems to be the right option. Purchase ledger account debit and credit the bank account because Purchase account represents amounts owed to credit suppliers, also called accounts payable. So when a check is paid to a supplier, so it reduces the amount owed. So the purchase ledger account is debit, and the bank account would be carried. Paying by a check decrease the bank balance, so the bank account is carried. So the double entry would be the debit purchase ledger control account and carried the bank account. And question number 5. Which business documents are used as a source of information to make entries in the cash book? So, first of all, let's talk about the bank statement. So, bank statement provides details of all transactions made through the bank, including deposits and withdrawals, which needs to be recorded in the cash book. And if we talk about the check counterfoil, so this is a record of checks issued used to record payments made in the cash book. And paying in slip, it is used when money is deposited into the bank, serving as a source of record receipt in the cash book. And the receipt is the proof of payments received, which are recorded in the cash book as income. So other documents such as invoice or petty cash vouchers relate more to recording in specific ledgers or petty cash books rather than cash book itself. So that's why C option is the right option. Bank statement is also the source, check counterfoil, paying in slip, and receipt. So C option is the right option. Let's see question number 4. So question number 4 is that Alex issued credit notes in August and entered them in the correct book of prime entry. So how was the total of this book prime entry recorded in the nominal ledger at the end of the August? Okay. So um, C option seems to be the right option, carried to the sales return account. Like if you talk about the credit note, so it is issued when customer return goods and they are recorded in the sale return journal book of prime entry, and this reduces the sales revenue as the goods have been returned. And the total of the sales return journal is then carried to the sales return account in the nominal ledger as sales return decreases the amount of sales. So the corresponding debit entry would be the debtor's customer account and reducing the amount the customer owes. So at the end of the August, the total of the sales return journal is credited to the sales return account in the nominal ledger. So C option is the right option. Let's see the question number 3. Jamil's financial year ends on 31st December. On 1st January 2021, he brought down a debit balance on his stationery account. So what does this balance represent? So when the credit a debit balance on the stationery account brought down at the start of the new financial year, which is 1st January 2021, would represent the value of stationery inventory carried forward from the previous year. And this is because the stationery account tracks the purchases and the usage of stationery. And if there is a debit balance at the start of the year, it means that there was unused stationery at the end of the previous year. So does the debit balance represent the inventory of stationery that Jamil had on hand as of 1st January 2021? So the correct answer is D, inventory of stationery on 1st January 2021. So this is the right answer. Yeah, sorry, like apologize for the this earlier confusion. Like the right option is not C, it is D. Because when credit notes are issued by Alex, so they relate to the return of goods sold to customers. So these returns are recorded in the sales return journal. So this is a book of prime entry. So sales return would use the total sales made by the business. Therefore, sale return account and the nominal ledger is debited to the reflect the reduction in revenue. And the corresponding credit would be made to the customer's account and the sale ledger. So as a customer, that decreases because of the return. So the correct entry would be debit the sales return account, credit the customer account. So that's why this is the right option, not this one. Okay. So now let's see the question number 2. The balances remaining The balances remaining on the books of business after the preparation of the income statement included the following. What was the total liabilities? Okay, so 10,000 is the liability. Wages due, this represents wages that the business still needs to pay, so it is a liability. Trade payables is, this is represent amounts the business owes to the supplier, so it is a liability. But if you see the other things like the rent prepaid, this is an asset, not a liability, as it represents the rent that has been paid in advance. Trade receivable is, this is also is an asset, money owed to the business by customers. Motor vehicle, this is an asset. Provision for depreciation of motor vehicle, this is a contra asset, not a liability. So the total liabilities would be 10,000 plus 620 plus 4650, and this would be equal to 15,270. So C option is the right option. Let's see the question number 1. So okay, so how does a trader use the information provided by the financial statements? So basically, financial statement provided a summary of a business financial position and performance over a specific period, typically including the income statement, balance sheet, and cash flow statements. A trader use this information. So um, if you see that the A, that to calculate the amount of cash drawings taken. So cash drawings are typically tracked separately and are not a primary use of financial statements. So this is not the right option. And the B is that to calculate the amount that is owed by the trade receivable. So trade receivable are shown on the balance sheet, but calculating them is not the main purpose of financial statement. C is to check the balance shown on the bank statement. So again, bank statement balances are not directly compared to the financial statement for this purpose. To compare a business performance over the number of years. Yes. By analyzing financial statement from different years, the trader can assess trends in revenue, profits, expenses, and other key financial indicators, helping to understand the business growth, profitability, and efficiency. So that's why the other options are less relevant for the overall purpose of the financial statement. So D option is the right option. Okay. So this is it for today. And I hope you are liking my video. As you can see that I am uploading, I have been uploading many videos on this channel for you students. So that's why I just want you to help me out, because as you can see that I have very lower number of subscribers. These are 297 only. So if you want me to to make these type of videos every day, and if you want me to to be successful, so please help me out. Please share this video with your friends so that they can subscribe to my channel. And if you didn't subscribe my channel yet, so I suggest you to subscribe my channel. So that's why whenever I will upload the video, so you will be get notified. Okay, goodbye, Allah Hafiz.